financial statements and financial reporting. And it is the end product of accounting. I always ask that question of students and even prospective employees. What is the end product of accounting? What does accounting produce? And the ultimate goal of all accounting systems is to keep a record and then produce financial statements so people can, that's the reporting, so people can read it and understand it. There's lots of different groups that are interested in understanding how a company's working, both internally, management, to see if if they're improving or meeting their goals, and then also external folks like bankers and investors and lots of others, regulatory folks. So Warren Buffett, I'm sure you've heard of him. He's one of the great investors, right? And he reads like 500 pages a day of 10Ks, of financial reports, of annual reports. The meat and potatoes of those financial reports, a 10K, is the financials, the audited financials that are in them. And so he says you have to understand accounting, and you have to understand the nuances of accounting. It's the language of business, and it's an imperfect language, but unless you're willing to put in the effort to learn accounting, how to read and interpret financial statements, that's what we're going to talk about here, you really shouldn't select stocks for yourself. So there's lots of things you shouldn't do, but selecting stocks and being an investor, you need to really understand accounting. And I remember when I was first interested in business, I was young. I was still a late teen, right? And I asked my girlfriend's father, who was a successful businessman. He had several factories and a real big plastics business. And I asked him, what should I learn if I want to learn, about business? I'm kind of interested. And he said, start with accounting. And I was like, oh, dude, that is just so boring. But really, it is the meat and potatoes. And it's not boring, actually, if you really get to it. Wolfgang von Goethe, right? One of the great writers of the 18th and 19th century overlapped. He said that double entry bookkeeping is one of the most beautiful discoveries of the human spirit. And back then and before that, for the Medicis and all the banking, that was double entry bookkeeping was a technology that was invented that transformed the world. It basically was one of the things that ushered in the Renaissance, because then they had money and they had leisure time and they could start going and collecting books and talking about them. And so double entry book, that's a remarkable statement from Goethe, right? That double entry bookkeeping is one of the most beautiful discoveries of the human spirit. And so keep that in mind as you think about this. Here's another one. I'm just trying to, get things that really reflect from very wise people how important accounting is. And it sounds extraordinary, but it's a fact that balance sheets can make fascinating reading. And Dame Mary Archer, a famous British scientist, said that. So what are financial statements? What do they constitute? Well, there's basically three financial statements, right? There's the income statement, the balance sheet, and the cash flow statement. And there's also a statement of equities, which is basically part of the balance sheet that keeps a record of who owns what as far as equity. In venture capital and early stage companies, they call it the cap table, the capitalization table. So who looks at these things, right? Who would be interested? Well, as I said, internal and external to the company, right? Management and competitors. If you're a public company, competitors are going to look at your 10K when you file it, and they're going to benchmark to your 10K to see how they're performing relative to you. And investors are going to do the same thing. They're going to we look at all the different companies, and we benchmark them to see which ones are doing best from a financial standpoint. We look at that over time, right? You can look at it longitudinally and vertically. You can do some analysis too within a company, but longitudinally over time, you look and see, how does this company compare with that company, and how does a particular company compare over time? Are they growing or are they diminishing? Bankers, all kinds of people that are going to put suppliers, they're going to supply. I want to make sure you're a strong company. You're going to be able to pay your bills, right? Big customers also, before they're going to sign a big long contract with a company, you want to know, is this company stable and substantial enough to be around in 5 years? If somebody gives you a 10-year warranty, you want to know, well, that's great, as a promise, but do you is it feasible that this company will be around in 10 years? So you look at the financial statements to see how solid they are, right? So management. Now we get into leadership and management and strategy, right? These kind of goals. It's internal information. There's managerial accounting, where you're actually this is information that's private to the company, and you look at things a little bit different, slice and dice the numbers a little bit different, aggregate them up. But so you can answer questions like, how are we doing? Are we doing better than we were? Are we meeting our goals? How are we performing? You may have in organizations performance bonuses that are based on meeting certain metrics, and you have dashboards that report these things to you very regularly, so you can see how many sales you've done, what's the expenses running, all those kind of things, so you can see how you're performing. And if it's a company with divisional departments, managers have P&L responsibility. That means profit and loss. They have responsibility for their own individual income statement within their division, so that they can be measured of how they're performing. So they can actually make decisions about costs and expenses, and also things to bring in more revenue, right? More sales. So they're charged with making money for the company. So investors, if you want to invest, and I'm sure you do. I would highly recommend it. It's the way to create wealth, is to invest in the stock market. And so you look at companies, and nowadays it's so easy to go to the SEC.gov website and Securities and Exchange Commission and see, look up a 10K on the Edgar system there, and read it and just quickly peruse it, or get really deep into it before and as you're doing investments. You may want to review a company from time to time, make sure that your thesis about them is still strong. So you invest in companies with strong financial performance, so they can grow. The money can grow, and you can compare across companies. Edgar is the tools on the SEC website, and that stands for Electronic Data Gathering and Retrieval System. And they invented that just before the web came out, and that is their electronic system for compiling these reports and then making them available. But it's really great. It used to be you had to go to a broker or to library and look in a telephone book size kind of compendium to see any financials and 10K reports, annual reports. Now you can just look them up online, and boom, 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 you can quickly, and they also will show you graphs and things of the salient numbers, so you can see how a company's performing. So bankers, right? Bankers are going to look. And if you ever want to get a loan from a bank as a company, you want to have good credit, even for personally, you have to do personal financial statements. And what are they going to do? They do credit analysis. And what's that? What is a loan? The credit risk is basically what is the likelihood of repaying that loan, and if you can't repay that loan, what's the collateral that you're putting up that then the bank gets? Just like with a mortgage with a house, right? What they get is they get the house until you pay off that loan, and if you default on your mortgage, well, then the bank comes, right, and takes the house and then sells it to cover the loan. That's how loans work. So they're going to solvency and liquidity. Do you have enough money to pay your bills, and debt coverage ratios? Do you have enough money to cover the income coming in to cover the monthly debt service fees costs? And so all of that's done with financial statement analysis, right? So let's look at a couple of the financial statements. Let's look at them. So a balance sheet. What is a balance sheet? Well, a balance sheet, like it says, it balances. It balances assets with liabilities and equity. And so on one side, you have all the assets you have, and on the other side, you have what you owe, the liabilities, and then also what's left over after that. This side needs to be more than your assets have to be more than your debt, and the difference is the equity. In a company, we do it in the United States from the most liquid to the most illiquid assets, right? So you start with cash and accounts receivables. Then you have your tangible assets like equipment, furniture, things that are tangible, right, that you could sell, but you can't sell them right away. Cash, basically liquidity means how quickly can you convert things to cash to address liabilities, basically. And then you have intangible assets like patents, intellectual property, the brand. But so up here intangible, you have all these different assets, and you depreciate these assets, right? You over the length of the time that you're going to use them, you take a portion of their cost, what you purchase them for each year, so that you spread out those costs, so it's more meaningful in your expenses how they're represented. Liabilities are your accounts payable, and that's everything from salaries to the electric bill to rent, all those kind of things that are you pay every month or whatever, your liabilities. Then you have debt, what you owe. Short-term debt means debt that's repaid within the year, and long-term debt is the portion of it that goes past a year, like say 5 or 10 year debt or whatever. The difference is retained earnings. And a way to think about a balance sheet, right? So this may seem like a lot of stuff, but just think of it like this. Think of it as like home ownership, right? And everyone understands that, right? You own a house and you have a mortgage, right? And the asset is the appraised value of that house, not necessarily what you paid for it, but the appraised value, right? As people like to look at what are the most recent sales of their neighbors, because then they can say, oh, if the price went up, then the price of the house is going up. That means relative to the mortgage, which is fixed, that's the loan, right? Then what's happening? Your equity is going up, your homeowner's equity. If your house is worth $100,000 and you have $75,000 mortgage, well, then you have what? $25,000 in equity, right? It's the difference. These two, 75 and 25, have to add up to the assets. That's the balancing part of it. This here, assets equal liabilities plus equity, that formula is called the accounting formula. That is the basic formula of accounting, and it comes from the balance sheet, right? Mortgage, by the way, interesting name because they're so long. Mort is the French word from the Latin for death. So a mortgage is really considered a lifelong, until you die kind of loan, right? So a very long loan. Usually in the United States they're like 30 years or 15 years. And in other countries, though, like in Japan, they have 100-year mortgages, right, to finance properties. So think of it like that. All the assets, you got all these different classes of assets, but just think of them as the value of the house, the appraised value of the house. And so just like in a house, you have lots of things, right? You have all your refrigerator and your stove and your bathroom stuff, and you could break it all down like this, but you just think of it as the entire value of the house, right? And then you have your mortgage, and that the collateral is the house, right? The bank has the house title until you pay off that mortgage, and then they send you that title. And then what's left over is the homeowner's equity. That's what they call it, being underwater when you have a asset like a house or anything else. Say if the house value drops down, say in the same, like we were talking about before, instead of $100,000, now it's worth $50,000, and you have a $75,000 mortgage. Well, now the mortgage, the debt, is worth more than the asset, and so now you're negative equity, right? And that's called being underwater. That's what they say with a car. I mean, if you get a car loan, you drive the car off the lot and it depreciates right away, and suddenly the car is worth less if you had to resell it than the loan you took out of it. That's why they say never put debt on a depreciating asset, because you consider land and buildings and homes as appreciating assets. They tend to go up all the time. Not all the time, but they tend to go up most of the time, right? Where a car, it goes down guaranteed most of the time, unless it's like some kind of fancy car, or even like now with Toyota Tacomas, these used cars right now are worth more than they were new because it's so difficult to get cars, and they're so popular. So the next one is the revenue income statement. That's just revenue minus expenses equals net income, right? Very simple. Your salary minus your expenses equals what you have left over, right? So what is accrual accounting is where you match expenses to revenues, and it's called the matching principle, and that's what you want to do, is match the two. The cash flow statement is necessary because there's non-cash accounts like depreciation and things within accrual accounting, And so the cash flow statement reconciles the income statement and the balance sheet for your cash position. And financial statement analysis, there's all these different ways to do that, right? You want to take, basically it's ratios because you want to eliminate size. If you want to talk about companies that are different size and all, you have to do ratios. So one number over like assets to liabilities, profits to as a percent of sales. The quick ratio is a popular one. That's current assets over current liabilities. You might want to think about net income per employee. How much, are your employees being productive? Or sales per square foot, the production in a retail store, say, or something. Inventory turnover, how quickly inventory is, when you build inventory, that you're actually selling it. You don't want inventory to stay around too long because it may get obsolete, right? And liquidity, do you have enough current assets to pay your current liability? So the quick ratio is a quick and dirty way to see, is there liquidity? Is the company going to be able to pay its bills? So there's two different words for that, right? Liquidity and solvency. So liquidity is cash on hand, and solvency is the ability to pay your debts, right? And how quickly can you turn an asset into cash? Because at the end of the day, cash is the thing that you need, right? You have to have cash to pay your bills. And on the balance sheet, assets are ranked by liquidity. You start with cash, and then you go down to things that take longer and longer to turn into cash. Like you may have, a car or a guitar or whatever you have, and it's worth money. But if you want to sell it, if you want to actually convert it into cash, it may take a few weeks. It may take a month. You may have to, if it's urgent, you need for cash, you may have to sell it cheaply because you need the money right now. So those are the kind of things you have to think about with a company too, and personally. As you look at thinking of your life, the enterprise components of your life, and thinking about financial statements of your personal financial statements. So what is financial reporting? Well, it's the preparing of the financial statements and notes about them, and it's audited. Basically, you want audited financials. A lot of times, even venture capitalists, if anybody's going to put money into a company, into your new startup, or if you're going to go to a bank, or if you're looking for investors, or if you're going to be an investor, you want to see audited statements by a certified public accountant, somebody who's certified to do that work. And there's all these rules, generally accepted accounting principles, they call them GAAP, and that's where those are the rules by which these statements are prepared. Right? They have to be prepared by CPAs in accordance with GAAP. And FASB, Financial Accounting Standards Board, is the one that oversees these kind of things, all those regulations. And if you're a public company, well, then there's regulatory issues, right? And you have to report your audited financials each year in a 10-K to the Securities and Exchange Commission, and they regulate companies to keep them honest, so that it's basically to protect investors, to make sure that companies aren't trying to rip them off. So where can you find financial statements of publicly traded companies? You can find tons of them. Go look at this site, www.sec.gov, or the websites of companies under their investor relations page. You can find them, or in investor websites. But this is what analysts do. There's buy side and sell side analysts that work for investment banks that review companies and make reports whether you should if to buy particular companies, or if they're actually, as investment banks, selling those securities. And basically they're the ones that put the story together about why it's a good deal or why stay away from it. And from time to time, analysts will analysts covering a company may say, strong buy recommendation, or, neutral, or it's a sell. And people refer to those to see whether or not they should get into a stock or not, or if they're into it, sell it, or to keep it. So what's inside a 10K? There's this whole course on 10Ks, so take that, or there's basically at the front page, right? This is Coca-Cola. This description of the company, history of the company, its competition. MD&A is a very important and interesting part of it to read. And that's management discussion and analysis, where where management discusses the numbers, discusses competition, makes predictions for what they think they're going to do in the future, why they performed better or worse than what they said they were going to do. And then there's audited financials in there, and there's an auditor letter in there that says, we've reviewed these financial statements and they are prepared in accordance with GAAP, and they sign that, and that's how you know that, you have that good housekeeping seal of approval that they've looked at these and these are good financials, at least as far as they know, right? There's no hanky-panky going on. And you've heard about all kinds of companies like Enron and WorldCom and these companies that, finagled their financials to make them look better, and then were found out about it, and it was fraud. They were defrauding investors, and so that's what these rules are for, to try to prevent that. And then there's notes on the financials. Particular numbers may have a note to it to say, explain how that number was computed. And it also, it's interesting, in a 10K, it'll say the executive compensation, how much executives are getting, in salary, in bonuses, in stock compensation, all that kind of stuff. Very interesting reading there, too. Well, that's it. That's, hope that gave you some good information about financial statements and financial reporting, why it's important, and who are the different stakeholders that are interested in financial reports. And I suggest go on that SEC website and just pick a company or 2 or 3 or 5 that you like, that you use, and go take a look at their 10Ks. Start to get comfortable and familiar with those, because that is the most valuable information as an investor that you can actually go and research and do your own research with. Okay, well, I'll catch you in the next lecture, and thanks very much for listening.